These 3 mistakes destroy stock accounts more than anything else. That's what we're getting into in this video. Before we get into those 3, thank you for being here. My name's Austin. I'm a co-owner of cloudmusicsuite.com and of course a stock market investor. So that's what we're talking about in this video today. If you're here in our first 100 subscribers, thank you so much for being one of those first 100. As a thank you for subscribing, here's a picture of my kitty cat. Her name's Millie. She's the sweetest girl I've ever met. She's also kind of crazy. All right, let's get into this. So the number 1 mistake that's going to destroy your stock accounts is going to be selling when there's peak fear and panic out there. All right, so there's always something to be scared of with stocks and any investment in general, and the financial media is going to make you even more scared. So one of the reasons that this is terrible is because now you have to be right 2 times, if not more. Maybe you're trying to sell like you think, oh, we're at the top. We hit the top of where the market's going to go for the next foreseeable future. Let me sell out here and I'll try to buy back in later. The odds of you being correct about where the top is are really low, and the odds of you being correct on where the bottom is are really low. So that's a loser's game in and of itself. No one knows how high the market's going to go. No one knows how low the market's going to go. So what's the purpose in trying to time it? Let's just stay in the market. They say that time in the market beats timing the market. Timing the market means I'm trying to get in and out of my positions, in and out of my ETFs, in and out of my individual stocks because of whatever is happening in the macroeconomic environment. The only reasons we should sell our individual stocks would be if the fundamentals of the company change. If the company is deteriorating in a massive way, you should probably sell out of that stock, okay? Another reason you might want to sell a stock is because the story has played out. You expected over a 3 to 5 year span that you were going to get a, let's say, 65 to 70% return. You got your 65 or 70% return. You don't really want to stay in that stock anymore. You see better opportunity elsewhere. Go ahead and take some of your profits. Take your money out of that stock, flip it into the next one, flip it into the next one, flip it into the next one, etc. You don't have to be married to a stock forever. If the story has played out, or if the fundamentals of the company got worse, go ahead and sell that stock. Only reason to sell your ETFs, in my opinion, is to fund your lifestyle. But if we're funding our lifestyle with our stock money, we're probably in the retirement phase. You're probably not in the retirement phase if you're trying to sell when there's peak fear and panic. Number 2 mistake that could totally destroy stock market accounts is giving up because results aren't coming fast enough. I haven't doubled my money yet. I'm not rich yet. So what's the purpose in even investing at all? This is a slow grind. It's a long grind. Whether you're an individual stock picker, whether you're an index fund investor, whether you buy bonds or mutual funds, it doesn't matter. This can't be a 1 year, 2 year, 3 year. It can't be that type of time horizon. Let's look on decades, not years. Let's look on years, not months, okay? Expand your time horizon a lot more, and it kind of gets a little more humbling. And just go for whatever number you need to invest on a monthly basis. I'm going to invest $1,000 on a monthly basis. Maybe that's your situation. Invest $1,000 on a monthly basis. Put it into your index funds. Maybe you do 80% in index funds, 20% in individual stocks, something like that. Stick to that allocation, get better, learn market psychology, understand how to value a company so that your individual stock picks get better. Understand the fluctuations that happen in the market. Don't worry when the index drops by 5%. Don't worry when it goes up 10%. Don't worry when it drops 15%. Just keep buying on a regular basis, especially if you're an index fund investor. It's very low risk since you're diversified so heavily, and those indexes, if a company's doing really poorly, they get dropped out of the index and someone else replaces them. All right, so this happens on a regular basis. There's rebalancing of these indexes on a very, very regular basis, at least every 3 months. So it's kind of rigged in your favor to go up over time. So just have faith. If you don't have faith in the US economy over a long period of time, very hard to be a stock market investor. So as long as you're bullish on the US economy, as long as you're bullish on the stock market in general, just keep on buying. Don't get wrapped up too much into, oh, I didn't hit my specific number goal in my portfolio this year. It is what it is. It's good to have goals, but a 20% a 20% drop is very possible, and a 20% upswing is very possible. You don't need to get super down when you have a 20% downswing. You don't need to get super crazy excited when you have a 20% upswing. So just stay the course, keep doing your thing, and expand that time horizon. Don't give up because it's not happening fast enough. It's not supposed to happen fast enough. If it's happening too fast, it's probably not sustainable. So it's better to get rich slowly over time, especially as it relates to the stock market. All right, number 3 mistake on what could destroy portfolios would be not knowing what you own and just buying on a whim. You heard Jim Cramer on Mad Money say, Tesla's a great buy right now. So you went and bought Tesla and now it's down 30%. You don't know anything about Tesla. You don't know anything about their revenues. You have no idea what their statement of cash flows looks like. You don't know where their balance sheet's at. You don't know what the projections of revenue are for the next 3 to 5 years. You know nothing about the company. All you know is they make cars. You're probably going to sell out of that whenever it drops 20%, which is inevitable. All right. Individual stocks are super volatile, especially, way more volatile than the index, let's say. So if I'm buying an individual stock that I know nothing about, I'm a lot more likely to sell out of that position. And I'm a lot more likely to get in at a bad price. Whenever someone's talking about a stock, it's probably because it went up a bunch. And, if it went up a bunch, it's probably going to go up a bunch more. False, all right? Completely false. Those are totally uncorrelated events. The fact that it went up in the past does not mean it's going to go up in the future, especially with an individual stock. So what you need to become is an analyst, basically. You need to be able to evaluate where this company's at right now, why it's going to be in a better position in the future, and whether or not it's a good buy at its current price. If it's not a good buy at its current price, figure out a price where you'd want to buy it, wait until it gets to that price, and then step in. If it never gets to that price, you're never going to step into that stock because the risk reward is not in your favor, right? So not knowing what you own is absolutely rampant. People get stock picks from everywhere. People heard someone on YouTube talk about a stock and they just bought in for whatever reason because that person said it was a good buy. They could be wrong. Or it was a good buy for them. Maybe they bought 30% lower than you did. Maybe they did have a great buy and they've just been holding that stock for the last year and they're just happening to talk about it because it gets clicks. A lot of options, a lot of ways that you could get duped, but make your own decisions. So try not to fall for these 3 mistakes that so many people make, some of the biggest 3 mistakes that I see out there in the market, and go ahead and make some gains. Stay in the market, have a long-term outlook, and know what you own. It's really that simple. Stay the course. If you made it this far in the video, go ahead and like and subscribe. Thank you so much, and have a great day.